I want to start out as we look into 2020. I'll start with you, Yelena. There's a lot of concern about whether the S&P and other things are overbought. But the question is, does the underlying economy support where the markets are? Because the markets are looking pretty good here at the end of the year.
Well, the economy is not looking that bad, I should say, but it's not looking great either. We do expect some slowdown going into the next year. So we expect 2.2% growth this year and slowing down to 2% next year. But consumers will continue to drive growth. And that's the most important thing, because it will be stable growth. We might see some slowdown in the first quarter, but going forward, it should be okay.
Well, Marvin, that's what my question really is. Does a sub 2% growth rate support where the markets are right now? Because the markets are quite robust.
Yeah. I mean, the animal spirits are high, that's for sure. I think when we kind of look at what we thought at the beginning of this year, in terms of trend growth and below trend growth and secular stagnation, we've really pushed that aside. And with the central banks pretty much asymmetric at this point, they're not going to hike. They have a proclivity to cut if need be. You know, those animal spirits can remain, pretty buoyant.
Peter, how much of it is the central banks?
You know, the other thing the central banks are doing right now, it's relevant to this morning, is they're looking ahead to December 31st. A lot of window dressing by corporations, want to clean up their balance sheets. A lot of foreign central banks foreigners have a demand for dollars. And so there's this worry that we're going to have a dollar shortage at the turn of the year. And so the Federal Reserve has been pumping a lot of money into the system for that reason. It's sort of a technical operation, but it's money, it's liquidity, and that alone can buoy the market. So I think that is a factor.
Yelena, is the Fed doing more than they're letting on to us as a practical matter to deal with this dollar shortage?
I think they're just taking care of what they're supposed to take care of, and I think they're handling it really well. So I think what we see right now is really what the Fed is supposed to do. But next year, we will probably hear less about policy rates, less on that front. It will be all about strategic reviews. We're going to hear about the inflation targeting review. We're going to hear about a new dot plot. So that's what we will focus on next year.
I would just say that I don't disagree with Yelena that they're doing things for the right reason. And so far, it seems to be like they have things under control. But, a lot of things can happen just in the next few days. So, stay tuned to Bloomberg TV as this thing develops. There could still be, we saw it happen in September. There was a huge spike in repo rates briefly up to 10%. It was, the Fed did not have things under control. So we believe they now do, but it remains to be seen. Let's actually see what happens over the turn of the year.
Yeah, I mean, the amazing thing with that is that it cost half a $500 billion to get us to a point where things are functioning, and the Fed didn't even think there was a problem back in September. So the problem was there. I do view that $500 billion to a certain degree as a version of QE, and that kind of is supporting the markets. I know it's controversial.
Says, no, it's not QE at all. We're just growing the balance sheet. It's not QE, right?
A lot of folks I work with say the same thing, but it is liquidity that's making its way into the system, and we've seen how important that is to asset values.
But did we make a mistake in not having a repo facility? Because that was talked about. Yeah, because that was talked about.
Standing repo facility, which sort of puts a cap on the funds rate and repo rates and so on, the whole complex of short-term rates. If you had a standing repo facility, it would do that. And I think Jay Powell has been under a lot of pressure to do that from a lot of people on the street. He hasn't done it yet. Seems to me like a reasonable idea, but he probably knows a lot more about it than I do. He may have reasons for opposing it.
Yelena, moving beyond the dollar liquidity issue, one of the things that I'm curious about is we've had a very strong year in the markets by and large. We've had 3 rate cuts from the Fed. Now we're talking about no rate cuts in 2020. There's a delta there. Are the markets going to continue to grow when you don't have 3 rate cuts coming in?
I think so. As long as the economy stays on the right path, I think it should be fine. But remember, the Fed always says we're going to do whatever it takes, right? If something goes wrong, they will jump in and, they can still deliver some rate cuts. They don't intend to. And by the way, the bar is raised so high for them to cut next year just because of the election. So it's very unusual for the central bank to do anything new to change the course of monetary policy in the election year.
Marvin, how much of the robustness we're seeing in the markets really is a matter of, if you forgive me, stopping beating your head against the wall so it feels so good? And I'm talking about trade. because we had the threat of trade, and it continued through the year. Now it appears maybe there's less of a threat with maybe a phase one agreement, which seems fairly limited, frankly. Is this just a matter of we're going to relieve you from that pain?
You know what? I think that what we learned about the U.S. economy kind of through this trade discussion is that the U.S. economy is much more resilient than a lot of people expected, particularly how quickly things deteriorated. What a phase one deal does, even though I do think it's limited, even though I think it will have a limited impact on economic data, is that it might allow businesses to get back engaged, which they really have pulled back from this year just because the unknown was so great. And when you're talking about, again, growth that's trend, maybe a little bit above trend, with employment where it is, an engaged consumer, and businesses maybe starting to tiptoe back in, we could look not bad as we go into the beginning half of 2020.
I just wanted to disagree a little bit with
please.
you, but I think it would take much more than just removing some uncertainty on the trade deal for businesses to jump back in and start investing. There are a couple of things, particularly in Q1. Remember, Boeing is having issues, and
Are they having
that
issues?
will weigh on economic growth. That will weigh on capital expenditures, and we actually saw a slowdown in corporate profits. So businesses need money to be able to invest. So that will also limit the extent to which they can do that.
So Yelena, you made the point earlier that the consumers you think can continue to be strong, but if in business investment is weak, there comes a point where consumers rely on businesses for their incomes, and so how long can the consumer expansion continue if business investment is weak?
Well, also, if we're talking about growth, you need productivity. And traditionally, a business investment is where you get productivity from. And where are we right now, Marvin, on business investment and capital investment?
Yeah, I mean, it certainly is cyclically low at this point. It's one of the questions that remains out there as we go into next year. That productivity needs to increase to have sustainable growth, but kind of as we look at it from a markets perspective, particularly over the next 2 quarters, let's say, I think that it could be somewhat supportive to kind of the story and the animal spirits that are out there right now.
One of the questions I have going into 2020 is the relationship between the U.S. economy and the Chinese economy, the 2 largest economies in the world right now. They have become quite entangled, really enmeshed. Let me ask you, Marvin, at the end of 2020, will they be less entangled than they were at the beginning?
No, I think that when you talk about 2 economies as important to kind of the global growth picture as you've laid out, as well as with the conversations around trade, which are going to continue, and they will continue for many, many years, the interconnectedness is going to be even greater.
I actually would disagree. I think what we're seeing is some gradual disentanglement, not to an extreme degree, but Chinese investment in the U.S. has fallen off a cliff, and it's harder for U.S. companies to invest in China. And so on the investment side, you clearly see some backing off. Trade, of course, we've seen the trade deficit, but the tariffs and so on. It's a matter of degree. I'm not saying that the 2 countries are going to become isolated from each other, but to David's question was just comparing from a year ago. And I would say the end of 2020 versus end of 2019 to end of 2018, yeah, I think there will be some departure of the 2 countries.
Well, Yelena, coming back to the U.S. economy, how will it be affected, if at all, by the answer to that question?
So I would say that it would be mutually beneficial for both economies if we see some easing in trade tensions. So we saw China lowering some tariffs on certain consumer imports. That would be beneficial for them. Some easing of trade tensions would be beneficial for the U.S. economy, and maybe we'll see some pickup in capital expenditures and business investment. So that's what we see going into next year.
So what is the main thing you're looking at in 2020 in terms of the U.S. economy, Peter? What will determine whether it goes well or badly?
I would go back to business investment, which in turn is related to confidence, which ties into some of the things we've been talking about here, like the trade deals and so on, and tax policy, and the election, who's going to be elected president. All these things will affect business confidence, which will affect business investment, which will, of course, affect all of us.
Same question to you, Marvin.
Yeah, I really do think it comes back to how businesses approach kind of the potentially more stable environment when we come to trade discussions. The consumer is engaged. He's about as engaged as he can be, and at the fringe it's going to be how businesses either choose to retrench or get more engaged again.
So, Yelena, we've had this conversation, and we haven't really talked much about the fact that it's an election year.
It is an election year.
Is that relevant, irrelevant?
I think it's very relevant, first of all, for central bank policy. So if you look at the past election cycles, you see that the central bank never changed the course of policy. So if they were on hold, they remained on hold. If they were hiking, they continued hiking, and the other way around. They were cutting during the Great Recession, and they continued cutting. It's very unusual for them to change the policy course, so which will be very interesting if the economy requires such a change. What will they do?
Marvin, last question. Is there a greater risk of recession or inflation for the United States in the next 12 months?
I think recession is still a greater risk.
You do?
Yeah, and I think, not that that's my base case at all.
No, I understand.
I do think recession is still, and again, it's the fact that we're 11 years into a cycle.
Right.
We are getting long in the tooth in pretty much any of the stronger measurements that the U.S. has. Right. And I think that's what frames kind of this asymmetric approach from the central banks.